In preparing for this show, I came across a column in Yahoo Finance that originated from Go Banking Rates entitled, Thinking About a Reverse Mortgage? Here are 4 expert reasons to think again. So what points does the expert make? Well, the columnist does get off to a good start by briefly summarizing just how a HECM works and the age requirements, noting that unlike traditional mortgages, the loan balance grows over time due to the accumulating interest and fees and significantly reduces the home's equity. However, the expert advice quickly strays into pure fiction. The columnist writes that initial cash loan from your lender might seem like a drop in the ocean compared to your home's equity. But in time, once you're used to taking the loan, your property loses value. Now, just how does taking out a reverse mortgage reduces a borrower's home property value? It really doesn't, and it may reduce the available equity if the growth of the loan balance actually exceeds the home's appreciation. Now, at first, I thought the columnist had confused the words equity with value. However, in his next statement, it left me speechless. And he says, when your home loses value, it forces a deed in lieu of foreclosure. This is the agreement between you, the borrower, and the lender to transfer the house to the lender. It's a common thing when a homeowner takes a reverse mortgage. A deed in lieu of foreclosure is actually not triggered by a loss in home value. A deed in lieu of foreclosure stops the foreclosure proceedings on a reverse mortgage, which is most often the result when the adult children or the heirs are inheriting a home from their parents that had a reverse mortgage and the loan balance exceeds the home's value at that time. A quick Google search would have avoided this mischaracterization. Next, the Go Banking Rates expert says, realtors are always advising homeowners against HECM loans. Always? All realtors? Now, real estate professionals in general are probably steering clients away from a reverse mortgage, but a number of realtors have come to embrace the HECM for Purchase program, which allows an older home buyer to purchase a home with a sizable down payment and then finance the balance with a reverse mortgage. Thus, they eliminate any mandatory monthly mortgage payments. And next in the column is one of the most common canards that I see in the media about reverse mortgages. The financial press gets this wrong consistently, but this could have been avoided by applying just some simple logic. A reverse mortgage does not relieve the homeowner of other expenses, so it does leave them at risk of foreclosure. They still must cover property taxes, homeowners insurance, and maintenance, said Joe Muck, who is quoted in the column, a Detroit realtor. Now, the columnist should have reached out to a reverse mortgage professional, as anyone with a traditional mortgage or a reverse is going to be obligated to pay those same expenses: property taxes, homeowners insurance premiums, HOA fees if they have them, lest they default on their loan and risk foreclosure. Now, all things considered, we can see that the so-called expert advice is often uninformed and misleads potential reverse mortgage borrowers in the financial press. And for that reason, I made these points in the post comment section, and also I emailed the same to Go Banking Rates editorial staff. Yes, we are back in black. The HECM portion of FHA's Mutual Mortgage Insurance Fund has reached a positive capital ratio for the 4th year in a row. Now, this is according to FHA's annual report to Congress, which was released earlier this month. Housing Wire's Reverse Mortgage Daily reports that in 2023, the HECM capital reserve declined just slightly because of a slower rate of home appreciation. Now, this year, that metric was actually stronger, and that led to a 7.78% increase in the HECM standalone capital ratio compared to just 1 year ago. Now, the economic value of the HECM program is especially sensitive to increases in interest rates or home appreciation or declines in appreciation, which has led to significant swings in the HECM portfolio valuation. The HECM portfolio accounts for roughly 5% of the total MMI fund, but it's largely indicative of the overall health of FHA's reverse mortgage program. In years past, the HECM program was unstable financially and maintained a negative capital ratio, but has stayed in the positive trajectory since 2021. The HECM portfolio has a standalone capital ratio that increased from 16% in fiscal year 2023 to 24.5% in 2024, said the report. The financial performance of the HECM portfolio improved mostly as a result of higher home price appreciation, or HPA forecast. Now, the HECM standalone capital ratio remained positive for the fourth year in a row, said the report to Congress. The HECM's cash flow net present value in 2024, which is a measure reported to Congress by the U.S. Department of Housing and Urban Development, was estimated to be about $8.399 billion, up from $6.742 billion in 2023, according to an actuarial review conducted by IT Data Consulting, LLC. Now, the standalone capital ratio of the HECM portfolio not only remained in positive territory in fiscal year 2024 at 24.5%, but it exceeded the previous high observed in 2022 of 22%. And that is despite the fact that overall HECM volume has declined in fiscal year 2024 when compared to data from the previous year. HECM endorsements increased from fiscal year 2019 to fiscal year 2022 by 106% when mortgage rates were historically low. Over the past 2 years, on a higher rate environment, HECM endorsements declined by 59%. As of September 30th, FHA has active insurance on an estimated 287,000 HECM loans. So we have just 287,000 that are active today out of the estimated 1.3 HECM loans that have been done. And in our last story, the dust from the presidential election is beginning to settle, but now financial pundits and real estate analysts are chiming in with their take. Many in the real estate business are elated with a Trump victory, and if the administration can live up to its campaign promises, rightfully so. For months, Trump has been advocating for lower interest rates, which have become one of the most significant barriers to home ownership in the post-pandemic years, said Alex Bean, a financial literary instructor at the University of Tennessee at Martin, in a recent Newsweek article. However, Newsweek does rightly point out that lower interest rates are what triggered the run-up in home prices after the pandemic and would likely do the same again. And speaking of home values, one thing that's been propping them up is a lack of housing inventory. Newsweek noted that approximately 1/3 of residential construction workers are foreign-born. If Trump were to make good on his plans to curtail illegal immigration via mass deportations, the home construction labor force could see a significant decline in available labor. Another concern is tariffs, which Trump has typically used as a negotiating tool. But if imposed, the price of imported materials that are used in home construction could increase significantly. However, beyond lower interest rates, a shortage of undocumented construction workers, and tariffs are concerns about the underlying structure, or the infrastructure, that is, of the U.S. housing finance market. The government-sponsored enterprises Fannie Mae and Freddie Mac. Now, we're going to be covering that topic in great deal in this Monday's edition of the Industry Leader Update, which you can find if you're listening right now at HECMWorld, HECMWorld.com. Thank you for joining us for this week's episode of HECMWorld Weekly. We would encourage you to subscribe to our YouTube channel, and we do also have an audio companion of this podcast, which you can find on Apple Music and Spotify. We look forward to seeing you next week with the nation's only weekly podcast bringing you, the mortgage professional, reverse mortgage news each and every week. Have a great day.